All right, let's jump right in. Today, we're tackling a chapter that is, and I'm not exaggerating, absolutely critical for your exams and for real-world accounting. We're talking about standard costing. This is going to be your A to Z revision guide, so let's get you ready to master it.
Okay, let me hit you with a quick exam-style question right off the bat. Imagine you see this in your paper. Your actual cost came in at 95 rupees. The standard cost, what you had planned for, was 100. So is this variance favorable? Think about it for a second. Your first instinct is probably screaming, yes, of course, we spent less than we planned.
But what if I told you the answer is not always? And this, my friends, is a classic ICAI trap. This is exactly where so many students lose easy marks because they're not thinking one step ahead. Understanding this little nuance is what makes it a CA-level answer, so let's make sure you never fall for this again.
To really get it, let's put ourselves in a real-life situation. Picture this. Your manager comes to your desk and says, hey, our costs went through the roof last month. Why? Now, you can't just say, they increased. That's not going to fly. A future chartered accountant needs to give a sharp, analytical answer, and believe me, standard costing is the exact tool that helps you do that.
So to give that brilliant, analytical answer, we have to start at the very beginning. We need to get the fundamentals down pat. So what on earth is a standard, and why do we even bother with them in the first place? Let's break it down.
So, standard costing, when you boil it down, isn't just about numbers. It's a powerful control technique. The whole idea is actually pretty simple. You set a target, that's your preset standard, and then you compare what actually happened against that target. The difference between the two? We call that a variance. This allows for something called management by exception, which is a fancy way of saying managers don't have to worry about what's going right. They can just focus their precious time on the things that went wrong.
And what about that target itself? Well, that's what we call the standard cost. Just think of it as the planned should-be cost for one unit of whatever you're doing. It's your benchmark, your North Star. It's what you should have spent. And this benchmark is the foundation for everything else we're going to talk about. Measuring performance, controlling costs, all of it.
Okay, but you might be thinking, why go through all this trouble? What's the point? Well, reason number one is super practical. It helps you estimate costs and set prices. Before you take on a new project or give a quote to a customer, these standard costs give you a solid, reliable base to figure out your selling price and make sure you're actually going to make a profit.
Reason number two, it gives everyone clear targets to aim for. You can't just tell a department manager, hey, do a good job this month. What does that even mean? But with standard costing, you can say, this standard for one unit is X. Your job is to hit that target. See? It's a clear, measurable goal that people can actually work towards. Third, these standards are basically the Lego bricks you use to build your company's budget. Your entire master budget is built on these standard costs. Then, when the period is over, you use those same standards to evaluate performance fairly. It helps you see who's doing a great job and who's struggling, and you can trace the reasons why. And finally, reason number four. Sometimes management just needs a quick update. They need to know how the business is doing right now, not weeks later when the final accounts are ready. Standard costs lets you quickly whip up a profit statement for internal use. Oh, and they're also super important for valuing your inventory correctly. Okay, so now we know what standards are and why they're so useful. But did you know there are different types of standards? You've got to know the difference between them, so pay close attention here. This is a very, very common theory question in the exam. First up, we have ideal standards. Think of this as the perfect world scenario. The best prices, machines that never break down, workers who are 100% efficient, you get the picture. The key thing to remember for your exam is that because these are pretty much impossible to achieve, they can be really demotivating. You'll almost always have bad variances, which makes them kind of useless for actual control.
Next are normal standards. These are way more realistic. They're based on what you can achieve under, well, normal conditions. It accounts for some downtime, some small issues, that sort of thing. The exam note here is that they can be tricky to set because you have to forecast what normal is going to look like in the future, and who has a crystal ball, right? Third, you have basic standards, sometimes called bogey standards. Think of these as a historical snapshot. You set them once, and then you don't touch them for a long, long time. They're not for day-to-day control, they're for tracking long-term trends. And here's the exam trick. You don't really calculate variances with these. Instead, you just show your actual cost as a percentage of that old basic cost to see how things have changed over the years. And finally, the most important one for practical purposes, current standards. These reflect what management actually expects to happen in the short term, like this year or this quarter. For your exam, just remember, this is the one that's used most often in the real world because it's the most relevant and provides a realistic target for right now.
So we've got the what, the why, and the different types. Now let's put it all together and see how this actually works from start to finish. What's the process? It's a really logical 5-step flow.
Okay, step 1, no surprise, is actually setting the standards. Step 2, you collect all the data on what really happened, your actual costs. Step 3 is where the magic happens. You compare the actuals to the standards and calculate the variances. Step 4 is the manager's job. You have to investigate those variances and find out why they happened. And finally, step 5 is for the accountants. You dispose of the variances by transferring them to the right accounts, usually your costing P&L.
Now that first step, setting standards, it sounds simple, but this is where theory gets real. And you better believe this is where ICAI loves to test your application skills with some tricky practical problems. So let's take a closer look. You don't just pull a standard out of thin air. It's a whole process. It's based on estimates, engineering specs, historical data, and what you think is going to happen in the future. And this is crucial. You set a standard for every single cost element, material, labor, overheads. And for each of those, you set 2 standards. One for quantity, like kilograms or hours, and one for price, like the rate per hour.
All right, let's make this real. Imagine you're the cost accountant. An engineer comes to you and gives you 3 options for the standard time to do a job. Option 1, 2 hours, which is what your absolute best, fastest operator can do. Option 2, 2.1 hours, the time for an average, well-trained worker. And option 3, 2.60 hours, which is just the average from the past. So, which one do you pick?
This problem perfectly shows the theory in action. If you pick 2.0 hours, you're setting an ideal standard. It's probably unrealistic, and you're just going to demotivate everyone with constant bad variances. If you pick 2.60 hours, you're using a basic historical standard. The problem is, it might be too easy, and it doesn't push anyone to get better. So the sweet spot is probably 2.10 hours. It's a normal or current standard. It's tough, but it's achievable, which makes it realistic and motivating.
All right, we are almost there. We've set our standards, measured our actuals, and now we've got these variances. The last and maybe the most important part of the puzzle is figuring out what these variances are actually telling us. It's time to decode them.
First things first, you have to split your variances into 2 big buckets, controllable and uncontrollable. A controllable variance is something a manager could have influenced, like being wasteful with materials. An uncontrollable variance is from something totally outside their control, like if the government suddenly raises the price of fuel. And here's the main takeaway. You can only hold a manager responsible for the variances they can actually control.
It's only fair. And this brings us right back to where we started. A variance can be favorable, which is good for profit, or adverse, which is bad. For costs, it's super simple. If your actual cost is less than the standard, it's favorable. If it's more, it's adverse. But, and here is the big ICAI twist, for sales, you flip the logic completely. A favorable sales variance is when your actual sales are greater than your target. An adverse one is when your sales are less than your target. So, was our 95 rupee cost favorable? Yes, for a cost it was. But if that was a sales figure against a target of 100, it would have been adverse.
Just imagine this. You're in the exam hall. A big, beefy 10-mark question on variances shows up. You get to work, you crunch the numbers, and your final answer for the total variance looks perfect. You're feeling pretty good about it. But then the results come out, and you got a big, fat 0 for that question. How on earth is that even possible? Well, it's possible because of a little secret about the ICAI exams. They don't really care about your final number. What they care about, what all the marks are attached to, is the breakdown. It's how you got there that counts. So, our only job today is to master that breakdown step by step so you can grab every single one of those marks. Think of this chart as our roadmap for today. It's the entire world of material variances laid out. We're going to start right at the top, and then we're going to systematically work our way down every single branch, every little pathway. By the end of this, you'll know this map like the back of your hand. So, first stop on our map, the very top of the tree, the material cost variance, or as we'll call it, MCV. This is the big picture number, the grand total. It's where it all begins. So what is it really? Well, in the simplest terms, it's just planned versus actual. The MCV tells you the difference between what you should have spent on materials for the amount of stuff you actually produced versus what you really did spend. That's it. That's the core idea. And here's the formula in action. It's really just standard cost minus actual cost. Your standard cost is the standard quantity you were supposed to use times the standard price you were supposed to pay. Your actual cost is, well, what actually happened. The difference between those two is your MCV. Simple as that. Okay, so let's say our total material cost was way off from the plan. Logically, there can only be two culprits, right? Either, 1, we paid a different price than we planned, or 2, we used a different amount of material than we planned. And that, my friends, brings us to our very first and most crucial breakdown. And here they are, the material price variance, or MPV, and the material usage variance, MUV. The MPV is all about the price tag. Did we pay more or less than our standard? The MUV is all about quantity. Did we use more or less raw material than the standard allowed for what we made? This is the fundamental first-level analysis you have to show. All right, enough theory. Let's get our hands dirty with a real example. We've got standard and actual data for making 100 kilograms of a product using 2 different materials, A and B. Seriously, the very first thing you should do in the exam is just lay out your data like this. It makes everything so much clearer. Okay, let's nail the price variance first. The formula is just the difference in price multiplied by the actual quantity you bought. So for material A, the standard price was 6, but we paid 7. Ouch! That extra 1 rupee multiplied by the 750 kgs we bought gives us a 750 adverse variance. Same sad story for material B. Add them up, and our total MPV is 1,250 adverse. Paying higher prices really cost us. Now let's look at the usage variance. The formula here is the difference in quantity, but notice this, it's multiplied by the standard price. For material A, we were allowed 800 kgs, but only used 750. Hey, not bad. We were efficient. That gives us a favorable variance. But for B, we used 100 kgs more than planned. That's adverse. So what's the net effect? 100 adverse variance overall. Now, for the most important part, the step you absolutely, positively cannot skip in the exam hall. The check, our total material cost variance is 1,350 adverse. Does our breakdown match? Let's see. 1,250 adverse from price plus 100 adverse from usage equals 1,350 adverse. Yes, it matches. This little reconciliation step is your proof that your calculations are solid. But wait, there's more. We can go even deeper. What if the reason our usage was off is a bit more complicated? You know, what if we're using multiple materials and we decided to change the recipe a little? This is a super common scenario in ICAI questions, and it means we need to break down our material usage variance even further. This brings us to a really important question. Okay, our total usage was off, but why? Was it because we deliberately changed the recipe, the mix of our inputs, or was it just because we were sloppy and had more wastage, a bad yield? We need to be able to separate these two effects to really understand what's going on. And to do that, we have to introduce the single most important concept in material variances. So listen up, because this is a huge ICAI favorite and exactly where students tend to lose marks. It's called the revised standard quantity, or RSQ. All it does is answer one simple question. Based on the total amount of materials we actually used, what should the mix have looked like if we just stuck to the original recipe? Now, don't let the name intimidate you. Cracking RSQ is actually really easy if you just follow this simple 3-step process every single time. Step 1, find your total actual quantity. Just add it all up. Step 2, figure out the standard recipe or ratio. And step 3, apply that standard ratio to your total actual quantity. That's it. That gives you the RSQ for every material. Now that we have RSQ, we can finally split our usage variance into 2 parts. The material mix variance, which compares RSQ to the actual quantity, tells us the cost impact of changing our recipe. And the material yield variance, which compares the standard quantity to RSQ, tells us all about our overall efficiency. Did we get the output we expected from the total materials we put in? Let's put this new tool to the test with a more complex problem. This is exactly the kind of thing you'll see in the exam. We've got a standard mix for making one single unit, but we actually went and produced 10 units using a totally different mix. Let's see if we can untangle this. Okay, first things first. And I'm telling you, this is a classic exam trap where people throw away easy marks. The standard data is for 1 unit, but we produced 10. So what do we have to do? Our standard quantity, our SQ, has to be for the actual output of 10 units. We have to multiply all the standard quantities by 10 to get the right starting point. Don't miss this. And now let's calculate our all-important RSQ using our trusty three-step process. Step 1, what's the total actual quantity? 2,460 units. Got it. Step 2, what's the standard mix ratio? It's 60 to 80 to 100. And step 3, we just apply that ratio to our total of 2,460. This tells us that if we had stuck to the recipe, we should have used 615 of X, 820 of Y, and 1,025 of Z. Now that we have RSQ, calculating the mix variance is a piece of cake. It's just RSQ minus the actual quantity times the standard price. And look at this. The total mix variance is 900 favorable. Why? Well, it seems we used more of the cheaper material Z and less of the more expensive Y. That change in recipe actually saved us money. But what about our yield? Here's the logic. For the 10 units we made, the standard says we should have only used a total of 2,400 kilograms of materials. But we actually used 2,460 kilograms. We put more stuff in than we should have for the output we got. That means our process was inefficient, our yield was poor, and that inefficiency cost us, giving us a yield variance of 1,250 adverse. And now the moment of truth. The final check. Does our breakdown work? Our total material usage variance was 350 adverse. Let's see, we have a 900 favorable from the mix, plus a 1,250 adverse from the yield, and what does that add up to? 350 adverse. It works. It all ties back perfectly. That's how you know you've nailed it.